Hello and welcome to today's webinar, Key Strategies to Build and Keep Generational Wealth. An exciting topic for sure. And I'm Jim Zahansky, Senior Managing Partner and Chief Strategist at WHZ Strategic Wealth Advisors. We're all thrilled to have you with us this morning for this critical topic that, amongst other things, is critical for each person that's joining us today, each person that may watch this in the future, for them and their families. So if you've been following along on this series that we've been collaborating on, you know that this hour is really the capstone of our 5-part series, which is getting ahead of the great wealth transfer. Over these 5 episodes, we have explored the largest movement of money in human history. We've explored, what's happening, why it matters, who's affected, and of course, how families and business owners can really plan around this great wealth transfer with intention. So today we're going to pull all those threads together. We're going to, sort of be sure that we answer questions that many of you have sent in and be sure that you're comfortable moving forward so you know how to approach this. And we're going to share the most important strategies and certainly the biggest pitfalls to avoid, practical steps that you can take starting tomorrow even. And, during the final 15 minutes of our hour together, we'll answer some of the questions you submitted in advance. We've received a great mix so far. Want to thank you for those. And if you don't get your question answered during the webinar, don't worry. We'll be sure to reach out afterwards to make sure that you get your answer. So before we get started and dig in, let me introduce this amazing panel that we've been collaborating with on this great wealth transfer topic. I'm Jim Zahansky. As you know, I'll be guiding the conversation today and trying to jump in and add some perspectives with the panelists alongside me here today. So as the Chief Strategist at WHZ, my work sits at the intersection of investment strategy, financial planning, family level decision making, and certainly, I hope to share some of those things we're seeing across our practice as we go forward. Along with me today, we have Leisl Langevin. She's a managing partner for advisory here at WHZ. Leisl is a certified financial planner professional as well as a certified divorce financial analyst, and she leads our advisory team here. She has been at the center of some of the most meaningful family conversations we've had with clients at WHZ. Leisl, welcome.
Thanks, Jim. Happy to be here.
Awesome. We're also joined again by 2 outstanding collaborators and from outside of our WHZ practice. The first is attorney Allison Poirier. She is a partner at KKC Law in Vernon, Connecticut, and she focuses on estate planning, trust administration, and elderly law. Allison brings legal perspectives we've leaned on throughout this series and with many of our clients. Allison, thanks again for being here today.
Great to be back, Jim.
Awesome. And of course, we have Kevin T. Lewis, who is the founder and partner at Rocklobs Advisory. He's a retired partner at PwC. Kevin advises business owners on succession, acquisitions, and exit strategies, really on how to translate decades of work into lasting wealth. Kevin, welcome back.
Thanks, Jim. Glad to be here.
Awesome. Well, let's get right into it. So, the big picture on why we're here and why this moment matters for many of you who have joined us this morning and many of you who will watch this afterwards. But essentially, the scene is this. The headline number that anchors the entire series is that there's a transfer of roughly, somewhere, between 80 and 120 million, trillion dollars. Million would be really small in terms of this context. But 100 plus trillion dollars, that's an estimated amount of wealth that's going to change hands from older generations, primarily the silent generation and baby boomers to Gen Xers to millennials and even to Gen Z over the next 2 decades. It's the single largest transfer of assets in history. But Leisl, headlines and reality aren't always the same thing. What's the this number actually mean to the average family?
Yeah, that's a great question, Jim, because the number itself can be a bit misleading. I mean, trillions of dollars sound, that's a big number. And the truth is that wealth won't be distributed evenly. And a meaningful share of it is likely concentrated in a small percentage of households. So at the same time, though, expectations in what millennials, for example, and Gen X think they might inherit from the baby boomers and silent generation is around 350,000, but boomers think they're giving in silent generation less than 250,000. So you can see there's a gap in that number, and that's really going to shape how families plan for this wealth transfer. And you really want to know what the specific situation is and what your family's actual situation is versus just assuming that you'll inherit millions. And so that's something that we consider in all of the planning that we do with our families.
Yeah, and these conversations, as you mentioned, are critical, right? And you have to include other sides of things. So, Allison, when you look at what Leisl just said from the legal perspective, what's the urgency you see?
So two things really, it's timing and structure. People are living longer. Healthcare costs are going up. Inflation is a continuing issue. So even larger estates can really dramatically shrink over time before they're ever going to be passed to the next generation. And without proper planning for things like probate, taxes, creditor exposure, these long-term care costs, all of these are going to chip away at what the heirs actually receive. So the choices people are making now in their 50s and their 60s and their 70s is what's going to determine how much control they retain and how much their family is going to benefit.
Yeah, and I'll add to that as well. I mean, it's not just an issue for wealthy families. There's a misconception a lot of times that the wealth transfer is it only really matters if you have millions of dollars. And it doesn't. I mean, we just mentioned a couple of numbers that could pass down to the next generation. And whether that transfer is 250 or 500,000 or 50 million, the same questions still apply. Who's going to get what? When are they going to get it? And under what conditions will there be a trust set up that will be maintained for their lifetime? And then are they prepared? That's the biggest question too, is of course they can inherit this money, but are they prepared to inherit, and do they match what the family values are as it relates to money? And so these questions, I mean, every family should be able to answer these. It's very important, no matter how much is transitioning.
Yeah. And these are sometimes tough conversations, Lizel and Allison, because they're not, families can perceive wealth to whatever number they can perceive it. However, whether it's 100,000 or less or more, it's important to those families, and they have to really consider them. And one area that we've focused on during these conversations, and many of them are on today, are really the business owners who work so hard in their business building value, and they sometimes often forget about how do they think about what's next and how to monetize that investment. So Kevin, as the leader of Rocklobs Advisory, who works with a ton of business owners, we have a number of them watching today, and for these business owners, the business is often the largest single asset. So how does this $100 trillion or more wealth transfer picture look from your seat?
It magnifies it, Jim. For business owners, the company is often 60, 70, even 80% of their net worth. So whether or not that business successfully transitions to family member, to employees, or to an outside buyer, that transition is what determines whether decades of work become generational wealth, or whether that wealth is discounted, dissipated if the business doesn't succeed through transition. And multiple pressures are hitting at the same time right now. A large percentage of owners are nearing retirement age, financing conditions are tighter, and economic uncertainty makes exits more complex. The owners who start planning early have more options and far better outcomes, and have choices that make both their family and their customers happy with the outcome. I always tell people to start the conversation 3 to 5 years before you actually want to leave the business.
Yeah, I mean, that is a good way to frame it up. The idea of 3 to 5 years is a really good time frame because you have to consider the value in the business, and you have to consider how to monetize that value. And it's always a reminder that this isn't a future problem. It's a now problem, right? I mean, we have to. It's not really a problem, but if you never do it, it becomes one, right? So. From our advisory practice, the clients that we sit with in most weeks, they really aren't worried about an abstract, $100 trillion number. They're more worried about their family. And the most useful thing that we can do as an advisor in that conversation is reframe the question. Instead of like, how much will I leave? What's the wealth supposed to do? That single question can shift all of the financial planning and the legal planning just by that conversation because it tells you sort of like what kind of investment risk should they take. I think when you think of it that way, you have to consider it tells Allison what kind of trust to draft. It tells Leisl and I and the advisory team at WHZ what conversations to have with the next generation. Whether the number is 500,000 or 50 million, the purpose is to first frame is identical. It's that time frame you need to plan for that and the tactics you have to put in place, like trusts and investment strategies and retirement income plans and tax strategies. It's particularly true that, as you're building wealth or selling businesses, tax strategies are really important. And that's the difference between wealth that quietly dissipates, sadly, or wealth that compounds across generations. So, with that backdrop, let's actually, let's talk a bit about what's changed about generational wealth. So, when you think a bit about that, and this speaks to Allison, Leisl, and Kevin, we in episode 2 of our series, we had a great conversation about, how values of wealth, mindsets, expectations, these are shifting between generations, Leisl. So can you bring us up to speed on, sort of what's really new?
Yeah, no, that's a great point to make. And I know we've had conversations about this, but the most important shift in my view in working with some of these next generation and the younger, the Gen X, the millennials, is that they approach wealth a lot differently than their parents did. And instead of focusing so much on accumulating that wealth and getting rich, they're more focused on the purpose, or they care about the meaning of what they're investing in and the financial freedom and independence that comes along with being able to support their lifestyle. So they care more about experiences versus things, and they are willing to save up for those vacations, but also put some money aside for their retirements. And so that has been something that's been interesting to watch as I've been in the industry. And the second shift is in the family dynamics themselves. And we've seen more blended households. There's longer lifespans, so maybe another marriage after a spouse has passed. And so the assets are a bit it becomes a little more complex when you think about who's going to inherit that next level wealth. And then there's also different types of investments too that we're considering and that more investors have access to. So that does add another layer of complexity. And but good conversations nonetheless, and very again, the next generation focused on how they're going to support their lifestyle. They want that financial freedom, and they care about those that they give more to charity, and they care about those that they're supporting. So.
Yeah, I mean that is one way to change it. I mean, and when you mention the idea of time frames, we're thinking about, when you think about generational wealth, the first step we often do with clients when we do a retirement income plan, right? Say someone's retiring in their 60s, and you're running out a retirement income plan into their 90s. Well, as generation wealth would consider, right? Well, what are the age of the children or the mixed families, or where do you want this money to go? That could be another 30 or 40 years on that time frame that we have to plan for. And that in fact shows up on the investment side of things, right? So when you're doing a retirement income plan, we're considering what's your investment risk? How are we investing for you? And what is that time frame? So instead of it being 30 years, when you think about generational wealth, that time frame could be 60 or 80 years or longer. And so, I'd say that's another change when you think about retirement income planning and generational wealth. And we have to consider things like there's significant interest, as you mentioned, in, digital currencies or ESG investing, which is environmental, social, and governance criteria. Other platforms like alternative investments and alternative assets like oil and gas, real estate, private placements, technology-driven platform. So the generational investors, when you are trying to transfer money across generations, you can't just think of that investment strategy as yours.
Mhm.
You want to take the risk that you have to take to meet your goals. But if we're transferring across generations, we may in fact invest very differently for that longer time horizon. So that's important, but it's also important to note that the fundamentals in that haven't changed. We consider things like, are we well diversified? Do we have cost controls in it? Do we have behavioral discipline? And those will always remain the foundation from our philosophy at WHZ from an investment point of view. Because these rising tide of new options, it is important to include, but does not replace the philosophical basics of investments. And especially when we're handling a wealth transfer, we want it to be safe, sensible structure that aligns to legal needs that Allison and her team might provide for us. And it has thoughtful exposure to some of the newer ideas around the edges that might give some upside to building wealth even further. So that's our consideration from the wealth side. Allison, from a legal perspective, what does this changing landscape mean for your estate documents you and the team might provide?
So it means that your estate planning documents have to evolve too. So if you own a family business, non-liquid real estate, or significant digital assets, your trust, your will, your estate planning documents have to have language that account for these assets, how they're valued, how they're going to be distributed, how they're going to be managed. And critically, what happens if the people you've intended to receive these assets aren't ready to receive them or simply don't want them. So we're seeing a lot more requests for transparency in plan design. Younger heirs increasingly want to be part of this conversation earlier. So at KKC, we incorporate succession planning, trustee readiness, and family governance into the estate plan itself. So it's no longer enough just to prepare a will and throw it in the drawer and call it an estate plan.
Yeah. Yeah, it makes sense. I mean, I can't tell you the number of clients we have sat across from that, hesitate to bring family into conversations earlier. And, you brought up the idea of transparency, Allison, and governance, right? So at one end, one end of the spectrum, you have families that don't talk about generational wealth transfer. And we would partake to say or put it out there that we would want transparency and governance around things. And Leisl, this sort of concept of family governance, it's probably one of the most underrated tools in this whole conversation, right?
Yeah, no, it is. And family governance, it sounds very official, but it just means having a clear structure for how the family makes decisions and communicates and then educates that next generation. I can tell when I meet with that next generation who has had the conversation with their parents about saving and about investing. And it's very interesting. They typically, the ones that are prepared are coming in and saying either I want to open an investment account or I already have a Roth IRA and I've started to invest. And then the ones that haven't had the conversation, it's much more of, okay, let's focus on budget, make sure that you have a good budget, and then beyond that we can start to invest if it's right. But you can definitely tell which families have had those conversations. And I mean, even having a simple annual family meeting and just having the values and how the family handles money can go a very long way. I've been in the industry for many years and dealing with trusts and beneficiaries, and you can tell the further you get away from the grantor of that original trust, the less they are, knowledgeable about managing wealth. And so it's an opportunity to add that additional education. And so we would call this and encourage that you have a legacy conversation. And it's a very approachable conversation with family. You talk about, here are my money values. Here's what, my parents taught me and what the expectations are if you were to inherit some of this money and responsibilities beyond that. And we have done some educational programming to heirs, and the things like how to read how many assets or liabilities do you have, like what's your personal balance sheet, and thinking about how to invest and what risk tolerance you might be able to take on versus your parents. So I mean, the truth is that there's some really important lessons for the heirs, and they might not be ready by default. And so the greatest thing to do is honestly have the conversation about it and make sure that they are prepared for when that wealth might be coming their way, and no matter how much it is, and they will be good stewards of it.
Yeah, I mean, good points, right? So if you're listening right now, I mean, the idea of generational wealth transfer is, first, you're building enough wealth to support your lifetime income plan and your goals. And should you realize in doing that you're, in excess of that, or you'll be leaving money, then the goal has to be how, right? I'm just sort of recapping where we're at. And you're working with your financial team to do that. You're working with your legal team to set up the right structure. And, then the step that sometimes is missed that you're talking about, Leisl, is talk about it with your family. Bring them in, understand sort of how that governance is being done, understand, so that they're those that are inheriting are prepared. And so, when you think about that, one of the areas that we have been talking about in this series, and Kevin had mentioned with Rocklobs Advisories, advising people as business owners 3 to 5 years in advance of the sale, be prepared. That means valuation. It means, what does it mean to you personally? It means you deciding, is there someone in your succession plan that is family? If so, how are you transferring that to them? And do you, as the business owner right now, have enough money? And so, Kevin, I think from the business side, how are you thinking about advising and preparing that next generation at a business sale?
Oh, absolutely, Jim. One of the biggest misconceptions we run into is the assumption that the business will pass to the family, no matter what. Is that going to work well? Sometimes it works beautifully. Sometimes, not. Either the not prepared family members or really don't want to be involved. So really need to understand, where the family sits. And, family succession requires capable next generation leadership, able to maintain the business, to govern it with the other owners of the family that are part of it, and has to be fair to all the stakeholders. So when these pieces aren't in place, alternatives like a management buyout, an ESOP with employees, a third-party sale can actually deliver better outcomes for the owner, the family, and the legacy of the business.
Yeah, and I mean, Kevin, you were a good point there. I just want to underscore, I mean, equal doesn't always mean equitable. And we've helped some families understand how to structure some of these outcomes when we're doing the financial planning. Let's say, to your point, Kevin, if one of the family members is in the business and they end up inheriting the business, and then you have another child that's not in the business, and so you want to be sure that you try to spread that across the families as much as you can. And again, having those conversations can prevent some of the fractures down the road that might come up if in family dynamics. So it's an interesting one to balance.
Yeah, I mean, and for those listening, I mean, Kevin is using words like, management buyout or ESOP or third-party sales. I mean, these are terms that help that build value for the existing owner. And then, the job that we collaborate with Rocklobs on is to then, how does that transcend into someone's personal financial plan and lifetime income plan? And then we would work with Allison's team at KKC to sort of build the right legal structure. during the sale and even after the sale. And those are really important things. Like, I want to build on what Leisl has said a bit, because I think something we find ourselves doing at WHZ almost every advisor meeting, the legacy conversation, it becomes, we sort of talk about a lifetime income plan. We talk about statistical probabilities of success. And then we talk a bit about, well, there's this much we see as excess to the plan in future value of dollars that you have. And this is I think it can be a structured conversation. It basically allows us to talk about things. And in this conversation, we don't really talk dollars. We say, hey, you're going to have a pretty big range left over. And then, you talk a bit about, well, each generation, actually believes about, what this money is good for. We ask the parents to consider what a successful outcome is 20 years from now, right? Like, you may not be here in 20 years. We're passing along some wealth. What's that look like to you to do? How important is it to you? How do you want that money structured? And third, how do the kids actually expect this? Because the gap between what, parents plan to leave and what kids think they'll receive is usually pretty significant. So how do we prepare them for that? And how do we set up the legal piece of it? And I'll tell you, in the number of years that we've advised families, these meetings, where we do all of this are ones where the eventual transfer goes very smoothly, because we've understood the legacy goals. We've understood how to set up the legal approach with Allison's office so that it goes smoothly. And, as an advisor, this is one of the highest value things that we can spend with clients, so that be sure that their goals live beyond them. And for those clients, they have enough to do everything they want in their lives, and sets up the next generation. So, that probably is, to sort of summarize where we are. We've talked a bit about the idea of what the structure of generational wealth is and how you build it. And obviously, it can be different amounts of money. And whatever that wealth is to you, being sure you have enough to support your lifestyle while you're living, and being sure that you've set up those after you in the way you would like, are really the themes. Whether you're a business owner, whether you're a professional, whether you've sold the business, or you've saved by working in a job saved your wealth in working in a job over a long period of time. It's important you consider these things. And one of the key topics as you consider our series of wealth transfer is the idea that wealth can surprise people the most, that women's wealth transfer is a significant part of the concept of wealth transfer. And, when you think about this, there are a number of reasons why women are at the center stage of this $100+ trillion wealth transfer, and they provide some unique perspectives, Leisl, correct?
Mm-hmm. They do, yeah. And I'll walk you through that. So with the great wealth transfer, women are projected to receive about 70% of that. And there's a couple of trends, as you mentioned, that are happening and why that may be. So in a husband-wife relationship, women tend to live longer than men. So likely they're going to survive their male counterpart and inherit the estate before passing it to the next generation. And at the same time, women are becoming primary earners. So they're the breadwinners in a lot of households now. They're also business owners building their own wealth. And they're also investing. I mean, if they're earning, they're saving in 401ks and other retirement accounts. And so all of this is coming together and creating this great wealth transfer to women that will, again, over the next 2 decades, likely 70% of that wealth will be in the hands of women. And so again, to further that, in 2024, there was a survey by the CFP board, and they found that 60% of women identified themselves as the main financial decision maker in their household. And so they're not just inheriting this wealth, they're also directing how it's being used in households, and our planning has to reflect that. I think that's been definitely, since I've been in the industry, a shift a bit. There used to be in a husband-wife relationship, typically the husband was making the decision. So we're seeing that women are making more of those financial decisions, and they're directing more of the wealth and building themselves over time.
Yeah, right. One of the funniest things that occurs, and I wouldn't say it's funny, but it's sort of can be a laughable moment in a client meeting, is when you're doing a lifetime income plan, and the woman and the man are the same age, if it's that kind of a couple, and we're projecting the woman to live longer because statistics provide that, right? And the husband says, well, you really, what, she's outliving me, right? And it's actually a funny moment, but I think in the sense, the implication it has is significant from an investment standpoint. And I had mentioned this earlier, because we're already planning for longer time horizons, right? So often people come in and they'll say they're in their 60s, shouldn't I be taking less risk? It really depends on your overall risk appetite, the time horizon we're planning for, already 20 or 30 years, or as I mentioned, in multiple generations could be much longer, 2 to 3 times that. And so if we're already planning for 20, 25, 30 years post-career, this means that the investment plan and the retirement income plan or the financial plan has to, sort of account for this decumulation as much as accumulation. So it has us think about things like, what's your long-term care risk, which is a significant risk to many, if not all of us, and what about healthcare inflation and healthcare costs, and how the portfolio supports your lifestyle and your needs without exposing it to undue volatility late in life. We also tend to see, as you think it through, it might be a generalization, but more focus among female clients, on impact that investments make on family relationships and philanthropy or giving. So the investment strategy has to be, a real true reflection of those priorities, so that, we don't just have a generic balanced portfolio for just your own lifetime, particularly if you want to transfer wealth. And I know this has some implications, I think, Allison, on the legal side too, when you consider these things.
Yeah, so it's just that your documents have to reflect your reality. So as we're advising more women as they step into these roles as trustees, executors, and leading beneficiaries of these estates, tailoring your documents accordingly. When a wife is younger than her husband, planning for her longer lifetime is essential. So that includes considering the things you mentioned, like taxes, but also potential future long-term care costs and asset protection. So we're seeing also more, as you mentioned too, Jim, these philanthropic strategies. So the use of donor advised funds, charitable trusts, that we're finding women tend to champion more and more. Estate plans need to anticipate the complexity of blended families, second marriages, stepchildren. Again, with this increasing longevity, and I think, Leisl, you had mentioned earlier, there's now this higher percentage of people who are remarrying. So we have more of these blended family situations. So the plan has to fit the family that exists, not just the family someone might have imagined 20 years ago.
Yeah, exactly. And I think, the biggest thing, again, we've been saying this all along, but having that conversation now, and whether you're a woman that will inherit, or you're building your own wealth, or you have a parent that's thinking about a granddaughter or daughter that will inherit and steward some wealth, you just have to make sure that you're engaging them in the family conversation. Sometimes you find that women, and they've said this, that they don't feel as confident in finance. And it really just starts with educating and having those conversations and being more deliberate about engaging them.
Yeah, it's such a, on a practical note, from some of the client work we've done here at WHZ, when and this is a pretty case that can happen often, but when a female or, when a woman moves into a primary decision-making role within the family or a steward of wealth, whether it's after a spouse passes or, after a divorce or simply just because wants to have a bigger part in the conversation, which is great. The most common mistake we often see is that the assumption that the existing financial plan should just continue. And this is a really important conversation because as a wealth advisory firm, we have to consider revisiting goals. They may have changed, right? Life changes, and we have to revisit risk tolerance, time horizons, and we have to revisit, their overall strategy. So, like, I mean, I remember this case we had, last year, a recent widow, I think in her late 60s. She had a plan that had largely been built around her husband's preferences and timelines. And when we re-anchored, when we had these conversations about what her goals were, I think her health, her likely 25-year time horizon, and her priorities, we changed her investment strategy or asset allocation materially. The income strategy changed. The estate documents that Allison and team were providing needed updating. None of this meant the original plan was bad. It just simply meant we needed to adjust the plan to the needs that she wanted and her goals. And as I mentioned before, as a wealth advisor, this is one of the most important and overlooked opportunities to genuinely serve our clients that we can provide. And it's usually collaboration with the legal team and many members of our advisory team here at WHZ. So, well, good topic. And I think when you bring in the idea of the business owner, we work with a number of female business owners as well. And there are, no matter the gender, obviously for owners that are watching today, Kevin, what do you think the single most important thing they need to internalize about generational wealth and business ownership?
Well, I think the first thing is, understanding that uncertainty in this area is not a reason to delay, that it really is time to plan early and intentionally, to understand that there's emotional time also involved in this, and that the owners who treat succession as an event that happens at the end get the worst outcomes. So, those who treat it as a multi-year purpose, process and have purpose get the best results, and strong businesses compare better outcomes in the market. So building a transferable business, one that's not entirely dependent on the owner, takes time. And again, it takes time for you to get comfortable as well with this transition.
Yeah, for sure. And I mean, I know there are attendees today where I'm having this very conversation with them right now. So maybe talk us through, Kevin, what's the very first step, maybe so an owner watches this and realizes that if they haven't started or wherever they are, what do they do tomorrow?
Yeah, it starts with an honest assessment. What is your business? How is it dependent on you? Are the financials clean and transferable? Could someone else actually run this business? And do they really want it? And you need someone to want your business and to run it well for you to get the wealth out of it. You don't need a full plan, but you need clarity, and clarity reveals the gap between where the business is today running with you and where it needs to be running without you. And that gap is the work that needs to be done early.
Yeah, no doubt. I mean, that's exactly sort of where we collaborate on, right? So, our work as a wealth advisory firm, connects with what you do. When an owner gets honest about these questions, on a wealth management side, we can immediately start building the bridge. We want to know what do we need to grow outside the business so the owner isn't depending on a single liquidity event 5 or 7 years from now. So in reality or in practice, for someone's financial plan, that means running 2 tracks at once. Obviously, we want to make sure they're building a business succession track, as you mentioned, Kevin, which is really your domains, what what you do. You're helping them value their business. You're helping them tidy up their balance sheet. You're trying to make sure that they maximize the value of the firm, and and make sure that it's transferable in a way that meets their goals. And then on a sort of parallel personal wealth track that we're running for someone's financial plan, as their advisor, it's to make sure that we're building a savings and a portfolio outside the business that is diversified away from that liquidity event risk. One that's tax efficient, one that's capable of supporting a lifestyle, and de-risks that eventual sale or liquidity, that they may get someday, and hopefully, working with you, Kevin, it gets more. So, when clients say to us, why should I take the money out of a business when it's growing or doing so well? It's because consideration, that worked when you were 45, isn't something from a concentration risk that puts you at risk when you're 60. Neither track alone is enough. We need to make sure we build it aligned. What's the value we get out of a business, and how do we diversify that risk overall? So, Leisl, from the advisory perspective, what are your thoughts on this idea of concentrated risk that it does exist for obviously business owners, but obviously overall, what do you think?
Yeah, well, right. It's one of the biggest threats for business owners and their long-term financial security. And Kevin mentioned, between 60 and 80% of their net worth could be locked up in one company. And so you're exposed to one industry, you have one set of customers and set of risks. And so really it's about building those different buckets. And you mentioned it, having savings beyond the business. So you have a savings bucket where you maybe have retirement accounts or individual or joint investment accounts. And then you've got the bucket of the business, and then your own personal assets where you're operating and spending, and you have your lifestyle. So we separating out those buckets, and then again with the investments, diversifying further away from the business, and just making sure that you're helping them to protect what they've built and positioning them for life after the business. And if the work that Kevin does is so important for those business owners as they're nearing retirement, because he's trying to help to get the most value for their company. And if maybe it's a little bit less than you were thinking it might be, it's good to have those separate investment assets that can provide that retirement income to you if the business maybe doesn't sell for as much as you were hoping. So that's really important, something that we focus on with our business owners quite a bit. And again, that succession and working with the clients and business owners and making sure that they know it's not just a transaction, and trying to help them navigate those alongside Kevin, and making sure that they're getting what they want for the business. And then beyond that, making sure that their business owner personal goals are satisfied for life after selling. And so that's all incorporated into their financial plan, and just making sure again that it's incorporated into the estate plan. We have tax planning with accountants, and again, that retirement income plan that might consider a business sale, and then the investments that they've saved over their lifetime. So when those are all coordinated, it really goes very, very smoothly.
And I'll just add, from the legal side, building these agreements early and having them in place is just so important. So things like buy-sell agreements, operating agreements, shareholder agreements, they don't get easier to negotiate later, particularly when the price tag is higher and there's already a buyer sitting at the table. It gets harder. So locking in the clarity now about valuation, about what happens if a partner is looking to leave the business or a partner passes away, what happens to their interests, about how those types of transitions are funded. So having these conversations early and putting these rules in place protects everybody, and including specifically that next generation that's going to be taking over.
Yeah, such a good point, Allison. If these are tough things to do, right? Oftentimes business owners are just going to start the business. I'm going to do well. I'm going to make money. I'm going to spend all, and then they don't think about these documents you're talking about, that are really critical and allow them to, think about and give them clarity later. So glad you brought the operating agreement, shareholder agreements, buy-sell agreements, really, really critical pieces. So thanks for that. And one that often comes up, we'd be remiss if we didn't bring this up, Kevin. I wanted to throw this one to you because we often sit around with business owners who, they think they want to pass along the business to a child or someone in their family, but, they're not sure how it's going to work. They're not sure they're going to be able to do it. What's the conversation they need to have?
Yeah, that honest conversation, Jim. First with themselves about, do they think the child can handle it? What do they need to do to grow to be able to handle it? And then with the child, does this person have the skills? Do they want to do it? They want to put the same amount of time and effort in? Are they being asked to take it on because, essentially you want to have some sense of the business even beyond when you own it. But, it might be time for the parent to let go. And that question could be, the answer to that could be an outside buyer, potentially an employee-owned business, an ESOP structure. And, those things can preserve the legacy and the wealth in ways family succession sometimes can't, and sometimes reduce the risk. The wrong answer is to assume and avoid that question because then you end up with an unprepared successor or a reluctant child, or conflicts that get created in the family when the business, doesn't succeed and, loses value, and then nobody makes a real good decision.
Yeah. Good context for the business owners on today. And, the intersection of what you just said is the current ownership may want to pass along the business to family members at some rate. They have to consider how much that is so that they can be sure they're getting the value they need to live on. So, that's a really, really important conversation that starts with your advisory firm advising the owners, what's this look like? You want to sell it to, your son? Okay, what's the cost of that? And then, the work we would do would be to be sure that's enough money to support your lifestyle. And the work that Allison and the team do is more about how do we set up that legal structure on the transfer. So really, really, really good conversation. And, we've talked about the generational wealth transfer at the macro picture. We've given some new realities of this transfer. We've talked a bit about the woman's transfer. What's their role in this 100 plus trillion dollars of transfer, and the stewards of that wealth. And we've talked about business owners and the special cases and considerations they have. So maybe we get into the sort of pillars of real legacy planning, the things every family should have in place. Allison, if you could kick us off, what are the foundational legal documents that people often overlook?
Yeah, and I think there are documents and kind of planning aspects that get overlooked just because, and I get why this is, but a lot of people think estate plans and they think I need a will, I need a trust, and they call that their estate plan. So, I mean, these are very important documents and I do highly recommend them. But documents that can get overlooked and where the gaps seem to be for a lot of folks is with the incapacity planning. So it's the powers of attorney, it's the healthcare proxies, the living wills. People not so much just planning for when they die, which again is more the will and the trust piece, but also planning for if something happens to them and they're still here, but they're not able to act for themselves anymore. So without these incapacity documents in place, a family can end up getting stuck in probate court and having judges deciding now if someone, needs to be appointed to, take care of yourself or your kids, whomever it is that's incapacitated. And the family, it can be a very adversarial process and the family can end up fighting over it. And this is all something that could have happened privately if just planning was done in advance. One of the things that can also get overlooked is once you have the plan in place, this is not something that is a one and done. This is something that you should be revisiting every approximately 3 to 5 years, just because things are going to change. Your family situation is going to change. So major events like marriages, births, deaths, divorces, the sale of a business, all these things might impact your plan. So you need to adjust the plan to accommodate for that. There's also going to be tax law changes or state law changes that might impact how your plan is ultimately going to play out. So you need to take those into account as well. So a plan that you maybe put in place 10, 15 years ago, when, could have been great at the time, but you need to pull that back out periodically and review it to make sure it's still doing what you want it to do. And if not, make those adjustments.
Yeah, well said. When the plan needs to change, the documents need to change. And Leisl, on the financial planning side, what are the pillars that add on to the legal structures that Allison was talking about?
Yeah, so the key pillars here for financial planning and ongoing management would be number one, making sure that you have the beneficiary designations and ensuring that that plan that Allison's team has put together is actually executed. That's number one there. So, and then another one is to make sure that you have the right financial team in order. So you want to be sure you have that all-star team, the financial advisor, the attorney, the accountant, and that they're all working together to be sure that your estate plan is executed. And then lastly, one other that I'll add is, and one that, of course, our financial planning process is having a financial plan and also an investment strategy. And we talked a lot about aligning goals and what those goals are now, but then what they'll be in 20, 30 years. And when your wealth gets passed down, those goals may change. And then it's making sure that you've got that right investment strategy that will, again, carry on your legacy. So during your lifetime, your investment strategy might be a bit different, but knowing that you might be passing some wealth down, it may shift as time goes on. So those are really the three main. So making sure you've got those beneficiary designations in your estate plan executed, an aligned professional team, and then, of course, our financial planning process of building a financial plan and having an investment strategy that helps you to achieve your financial goals.
Yeah, right. I mean, and at WHZ, we connect the planning phase, we call it plan well, to the invest well phase, because on the investment side, there are really two pillars to consider. First you have to identify where the wealth lives. This is the type of accounts Leisl and Allison were talking about. Retirement accounts, taxable accounts, real estate, business interests, life insurance. For each of these, you have to know its liquidity, its tax treatment, and how it transfers to the next generation. Because some assets sort of pass under the will, some will pass by beneficiary, some pass by titling. So obviously these behave differently, and your strategy has to reflect that. Secondly, and this is something we're really big on at WHZ, is sort of build flexibility into the plan. You never know what exactly is going to happen. You don't know exactly when an inheritance will come. You don't know exactly what the tax law will look at like in 10 years. So, the idea of being nimble and flexible and being able to change document that Allison brought up is really important. So, obviously this plan that's built across this professional team needs to be designed to be flexible, to flex through trust structures, stage distributions, review checkpoints, and there might, Kevin, be some special considerations for business owners.
Yeah, two pillars from the business side as well. First, get your financials and your operations clean and most importantly, transferable. Buyers, whether family, employees, or third parties, pay more for businesses that don't depend on the day-to-day operations being led by the owner and being in the building all the time. Second, separate the personal from the business. Build personal wealth outside the company alongside the business itself, considering business investment versus personal investments and the returns, and keep your balance sheet diversified and protect both your family, and yourself.
Yeah, I mean, it's a good point for business owners and generally others that are here today. But I mean, one of the things I'd add is, as another pillar, perhaps, and we think about this as maybe one of the most underrated, is integration, right? So oftentimes people will show up and say, well, I've got this business and it's going to sell for this amount of money and I'm good. Okay. Well, what documents do you have in place from a legal perspective? Have you, considered your lifetime income plan? What's your, investment strategy? And as a senior advisor for a family's overall plan and their success, it's our responsibility to make sure that those pillars are talking to each other. That the legal documents allow us to title accounts appropriately, that they're tax efficient and talk to what the CPA might want, that the valuation that Rocklobs advisory does for a business owner is put into a retirement income plan for someone appropriately and with the right tax thing, because those details of integration matter. And someone's first single up-to-date balance sheet that reflects everything from retirement accounts to taxable accounts, real estate, business interests, beneficiary designation, having all of these together. Most clients haven't seen these things on one page, and that's something that we do together. Second, make sure you have the right team, as Leisl mentioned. Have the right attorney, the right CPA, the right business advisory firm. Sometimes like a business consulting like Rocklobs Advisory and Kevin. Sometimes you need an insurance specialist for high net worth, right? Oftentimes you may not have enough protection, right? Do you have the right insurance coverage to make sure you're minimizing your future risk or helping to pay future taxes in your estate? And third, sort of running a formal review of these at least annually is critical. And, you have to ask this question, has anything changed? And should we update documents, as Allison says, to keep them fresh? So, I think getting to the point of getting the right team in place is really important. And we've given you enough thinking here so far to make sure that you have the right plan in place and the right team in place. But maybe we should talk a little bit about pitfalls because those can happen. We've covered strategy and what could go wrong, Allison?
Inactivity is one of the biggest problems. So often I hear people say, "Oh, we'll get to it later. We just need time. We'll get to it later." And later becomes never. And what we're left with then is outdated documents. We're dealing with families going through probate court for, assets that could have bypassed that process if they had just done more planning ahead of time. Now we're paying taxes that could potentially have been avoided, heirs that are unprepared to receive assets. So that inactivity, that cost of not planning is always almost larger than the cost of doing the planning ahead of time.
Yeah, and I would add to that, I'd say for me, it would be the pitfall would be misalignment. And that would be, again, heirs unprepared for the responsibility of carrying out the family wealth, whether the values were never communicated. You didn't have those annual family governance official meetings that I spoke about earlier. But it's making sure that next generation is ready to receive this money and that they will be good stewards of it because you've had those great conversations and making sure that they know what you value and how you want them to carry that out.
And from the business side, assuming the next generation is ready or wants the business by default, they might not. Either answer is fine, but not knowing is a mistake.
Yeah, I'll add to that. I mean, this theme of integration, right? So, one pitfall that sums up everything is the failure to coordinate and integrate these things. The advisor doesn't talk to the attorney doesn't talk to the CPA doesn't know the business succession plan from Rocklobs, and each professional is doing really good work in their own lane, but they're not intersecting it. So, I think to sum up this in one sentence for those listeners and those that have joined us today, plan early, coordinate the team, communicate with your family, update regularly, and certainly build flexibility with that team. We don't want to sort of end things without an action plan. Those of you that have joined us or those of you that are watching afterward, you want to have, if our team, we have a bias for action. So, let's talk about a 30, 60, 90-day action plan. Today, when you get off, maybe your move today is write one paragraph, like before you go to the next thing, one paragraph that describe, what does it look like to do well for you and your family in the next 20 years? Maybe it's not in dollars, but in life. Where do you live? Who's around the table? what's your family doing with what you've built? As an advisor, an advisory firm, we can tell you that in one paragraph, it's more useful to us than a stack of statements, because these sorts of things tells us that you're actually planning forward. And every recommendation we make from there would be try to getting you to where you want to be in the 20 years. Leisl, what's the 30-day move?
Yeah, the 30-day move would be to have that conversation. And again, it would be having the conversation about the family wealth and with your spouse first, then have it with your adult children or your parents if you're on the other side of the inheritance question. And just have that general conversation about wealth. Don't talk about dollars necessarily. That will be important at some point, but starting it to understand what are their values, what hopes do they have for this money, and what are their expectations. And again, answering that question, what do we want this wealth to do? And that can really frame everything that follows.
And Allison, I mean, that's so we got, okay, what do you do now? You write a paragraph, and then obviously in the 30 days, this has you think a little bit differently. Now on to the 60 days, Allison. What's the move here?
Inventory and review. Pull out your will, pull out your trust if you have one, review your beneficiary designations, your powers of attorney, your healthcare proxies, read all your documents. And if you don't understand something that's in them, that's exactly what your attorney is for. And also, if these documents are more than 5 years old, they're almost always due for a refresh.
Yeah, no doubt about it. And the 90-day plan, right? So 30, 60, 90 makes sense. These are good action plans. Map the assets in the team. List everything you own. Where does it live? Identify the professionals that advise and what they do. Then schedule, and coordinate a meeting, with your financial advisor. Maybe they can coordinate it for you, include your attorney, make sure that they're talking to each other, maybe your CPA. And make sure you can try to get them all in one room so that everything is coordinated. And this is really, really important to do within the 90-day period if you haven't done it already. Kev, anything for the business owners in the 90 days we should think about?
Yeah, real assessment of the business, the three questions that we talked about before: owner dependency, financial cleanliness, realistic successions. Write those answers down, show them to a trusted advisor. That's the starting point, but then also invest the time to keep moving.
Yeah, no doubt. And for those business owners that are on today, I mean, it's tough to allocate time to think about the future when you're in it, but don't forget to do that. And I think for us at WHZ as wealth advisors, this is the thing we do. We organize all of this through what we call affectionately our plan well, invest well, live well process. We've talked a lot about this today, but planning well means putting the strategy in place, the values, the goals, the structure, and the documents, having the right partners like Allison and her team, or Rocklobs and team, or the right CPA team. Invest well means building and managing a portfolio that supports your plan, which might include generational wealth, and have the right investment strategy to do that. And ultimately, the one we sort of make like the most is to hope that you live well through our plan. And as a result, you have the confidence and the freedom, the ability to pursue what matters most to you. And it's how we deliver on our promise of absolute confidence, unwavering partnership for life. It's the framework underneath everything we do here at WHZ and what we discussed today. And we thank those of you who have joined us for the last hour. And there had been some questions that have come in, and I think what we could do is make sure that we answer all of them as a follow-up to you. And maybe we would take just one question that came in, given the time we're at. So I think the first question and the last we'll cover on this this forum, and we'll make sure we get follow-up to those that have joined. This is the one that says, this year we may be in a financial position to gift our two sons each of the full allowable amount annually. Is it a wise strategy to build generational wealth? If so, what should we do with this money each year to maximize growth? Leisl, this is probably one for you, I think.
Yeah, certainly. And we've been seeing this. A lot of clients have mentioned giving to their kids now versus when they pass. So we definitely are seeing more of the giving while living in retirement. And so this is a great way to build wealth outside of your own estate plan. So we know there's the lifetime exemption amount. It's pretty high right now, but the gifting every year does give you the ability to create that generational wealth outside of your own estate for that next generation. And then you can also help them and guide them on the stewardship of that money. And then typically what it does is it has them having a conversation with the parent's financial advisor to say, how should I invest this money, and creating their own financial plan. So that's a great way to do it. In terms of maximizing the wealth, it would be to consider what types of investment accounts, whether it's an individual investment account maybe, or a Roth IRA. If they have earned income, you might be able to save in that, which would be tax deferred and allow that growth to happen over time. And again, when you're thinking of that next generation, they're probably not going to have the same investment strategy as you. And so you're likely going to have a more aggressive investment strategy that takes on a bit more risk because they have a longer time frame. And so, I mean, we see this quite a bit. And again, it depends on the situation that next generation is in too. You want to be sure that you're giving that money to them. They know what to do with it, but it does lead to very good conversations and often a meeting with a financial advisor. So certainly a great way to, again, get money out of your own estate if you're going to have an estate exemption issue, and then also try to maximize that growth by investing in likely a more aggressive investment strategy than your own because you're giving to that next generation.
Yeah, thanks for taking that one. And while there are other questions that have come in, we will of course answer those for those that have registered today. We'll make sure that you get those together. I mean, we're getting to just slightly over the time we have. So what a great hour. I mean, thanks to those that have joined us today. We really appreciate your questions and your time. I also want to thank Leisl and Allison and Kevin. Yeah, as always, and throughout the series, your insight's been awesome. Great expertise here that we've assembled, and your generosity throughout the entire series has been outstanding. For those of you that are listening or going to see this on demand afterward, the full 5-episode series of the Generational Wealth Transfer is available at whzwealth.com or forward, I think it's / actually, I always get that wrong. So whzwealth.com / wealth transfer. And while you're there, download the free guide that we put together with KKC, Smart Strategies for Generational Wealth. And that pulls together resources for all of you, conversation starters, certainly fun things for the summer barbecues, I'm sure. Checklists we've referenced throughout the series. And, if you'd like to take the next step, and if you're not already having these conversations for planning, you can always set up time with us at whzwealth.com or call us at 860-928-2341. And we'll work, of course, to help you gain absolute confidence, unwavering partnership for life. Along with our partners at KKC Law, if you would like to have a consult with attorney Poirier for any legal estate planning, or any of her peers at KKC Law, their website is kkc-law.com, or you can reach out at 860-646-1974. And if you were intrigued as a business owner by anything that Rocklobs Advisory and Kevin Lewis said, their website is rocklobs.com and can be reached at 617-899-0773. So on behalf of the panelists, I'd like to say thanks for joining us. And I'm Jim Zahansky. On behalf of all my partners, thanks for joining us today. Have a wonderful rest of the week.